amongst other things, autos really closely all through the years. And Ashwin, great having you. It's been a while. Niraj here, thanks so much for joining in. And I wonder if you believe or whether you are as concerned or a little bit concerned about the margin impact on the auto sector in Q3 because of the price movements of raw materials.
Yeah, thanks, Niraj. Once again, good morning. Great to connect with you after a long while. Talking about autos, I guess, the analysis which was shown was really very great. And from that only, I can definitely say that the impact on the two-wheelers and the passenger vehicles will be more than the tractors and the commercial vehicles. Because if you see for the tractors, rubber is one of the main ingredient. Because if you look at the tires and all, there are a couple of big tires at the rear and smaller tires at the front, and that shows that the tractor consumption of rubber is more than any other subsector within the autos. So since the crude, the steel and the rubber prices have moved positively, they have decreased, so that's a positive impact for the tractor makers. But as far as the other raw materials are concerned, like aluminium and copper, copper is one of the biggest contributor after steel and aluminium in a vehicle, because all those wirings and all are made up of copper, and copper is also used in certain other products which go into an automobile. Therefore, I think aluminium and copper increase will be hurting the automakers to a greater extent than any other. So I think, the margin impact definitely will be seen in Q3, but, looking at the volumes that have grown, the GST impact is there. So that may, somewhat offset the impact on the margins, because volumes will be higher.
But Ashwin, I'm just wondering then, therefore, isn't the tractor space, which is the commentary has been good, presuming the numbers would have been okay, and there is a possibility of a positive margin impact for Q3 play, isn't tractors the best place to fish in from a long perspective?
Absolutely correct, Niraj. I think that tractor makers like Mahindra and Mahindra, Escorts, BST Tillers, Tractors, all these companies will be facing, a good quarter in Q3 as compared to the other automakers, because definitely, they will be getting some sort of surge in the margins as well as the volumes, because we have seen greater, volumes on the part of tractors stemming from a superb monsoon this year. The Rabi sowing has been good. The Kharif output is coming out well. So, the water reservoirs are, almost full. So the tractors are in a sweeter spot than any other segment within the auto space. So I think, as I've said earlier, also all these three stocks will be in a better position as far as the Q3 numbers are concerned.
So last question really, beyond tractors, is there something that you're watching out for Q3, or your top ideas as things stand right now for calendar year 26?
Within tractors, we like M&M the most. That is the top, pick within the tractors and overall auto sector as well. Because, the UV space is also buzzing well. The EVs, they are launching really very well. And the market is also responding well. They are, posting growth close to about 15-16% every month. So M&M is my top pick within the auto space. Followed by, within the two-wheelers, we like TVS as well as Hero MotoCorp, because of the domestic growth that TVS is doing is fantastic. And the kind of vehicles and the market share growth that Hero is showing is superb on the EV front. And, within the passenger vehicles, as I said, Mahindra and Mahindra is a two-pronged player in the passenger vehicle space as well as in the tractor space. So these three stocks are my top picks, and within the CVs, we like Ashok Leyland.
Okay. Ashok Leyland amongst the CV plays. Mahindra and Mahindra arguably seems like the top draw. Ashwin, have a fantastic year-end and best wishes for calendar year 26. Thanks so much for joining us today.
Same to you, Niraj. Have a great year 2026.
Thank you.
Thanks. Bye. See you again.
I think that's the hope for all. Great year of 2026. Is Pratik Maheshwari, co-founder of PhysicsWallah, going to have a great year, and is the company going to have a great year? That's the next conversation we're having. Pratik, great to speak with you again, and thank you so much for your time with us here at NDTV Profit. So I think your company had what many would call a dream debut. And I remember our conversation on the day that your stock listed, and you said we couldn't even believe that this was maybe our company which has seen this kind of a zoom. Since then, so much more happening, some volatility, some initiating notes. First of all, key lessons, and then we'll come to the outlook for 2026.
So amazing year. Last year was for the company a great outcome in terms of a marquee listing. That makes us the largest education company at this point of time in the country, and we are seeing solid growth in future both in our online learning and offline mode of learning. So continue to grow faster as both top line and bottom line in upcoming years.
Started spending some of those IPO proceeds, one acquisition, more centers being opened up. Just give us a roadmap of this. What are the next few months going to look like? Is it going to be a lot of capital expenditure?
Historically also we have been very frugal in terms of deploying the capital. Online doesn't need capital for further expansion. Any online category gets break even in very first year of its operation and start generating cash from second year of operation. Online margins are very high. We as at a category level we have 45 to 60% margins in our online business. We don't need capital to expand in online, but there will be some consolidation of a small players in our online mode. For example, the way we have done Xylem, the way we have done Utkarsh, we will continue to grow as a house of brands in online. So there will be some announcement in upcoming quarters in our online mode of learning. Offline, we are number 5th player at this point of time. And the number 1 to 4 player together are doing more than $2 billion of revenue, and we are doing only $150 million of revenue. So there is a huge headroom to expand in offline, and we will be opening 200 more centers in next 3 years. 75 centers will be opened in FY27, and already we have signed those leases and continue to grow stronger in offline mode of learning. Next year will become profitable, PAT level profitable at a group level, at a company level, and our offline mode of learning will also become EBITDA profitable next year.
No, so a lot of things that you've said together, Pratik. So let me break into them one by one. One, you talked about your offline, your online margins between 45 to 60%, if I heard you correctly. Right? What are your offline margins? Because that's where the new growth seems to be coming from.
So offline margins are anywhere between 13 to 18% at a steady state, but offline ARPUs are 10 times more than online ARPUs. So it has more potential to increase our overall blended ARPU, the average revenue per user. But offline margin are 13 to 18%, in that is the industry standard.
New companies and new kinds of companies, there are new ways of describing them. Average revenue per user is usually something you have in the telecom industry. Having said that, what is your ARPU right now and where do you expect it to go?
So this year, the ARPU will be close to 4,000 rupees for the entire year of operations, both blended online and offline learners put together. And we don't want to increase it very rapidly. We will do only inflation adjustment, the cost of living adjustments, because the companies stand for access. The companies stand for availability of a good quality education to every pin code of India.
And any reason why the average revenue per user is, or I suppose the average spend per student, if I were to put it in a different way, is higher than in offline, in physical classes rather than in online classes?
See, online we operate on a mega classrooms where thousands of learners study together in one live environment. So cost of operations, cost of delivery is very minuscule there. Vis-a-vis offline, you have to do capex, you have to pay rentals, you have to pay, and the student-teacher ratio cannot go in thousands. Our online student-teacher ratio is one teacher is teaching 10,000 kids. 500 teachers put together teaching 50 lakh students. But offline, there are 2,500 students teaching close to 3,30,000 kids. So the student teacher ratio cannot exponentially rise in offline mode of learning, and there is a capex and the rental requirement as well.
So, when you're talking about that, Pratik, good morning, Hiral on this side. What's the center rollout strategy going to look like? Because you've said, 75 plus new centers in FY26. So, what is the potential nascent margin risks that were flagged by analysts earlier? How are you going to deal with that? And two, when you talk about this Vidyapeeth versus Pathshala, how will that capital allocation actually differ in 26 between Vidyapeeth? Because that is going to be high investments. And you have tech-enabled Pathshala, which will be hybrid models.
So if you see our track record in past 2 years, we have opened 170 centers. Our peak losses of offline are gone. Gone are those days where offline used to bleed. Already the centers which we have opened in FY23, FY24 are generating cash for us. So for further expansion from here, Vidyapeeth is self-sufficient, capitalized to expand further. Normally it takes 2.5 crore to open a center. We are opening 75 centers, sitting, that will require 150 crores of capital requirement, which is very less for a large company like us. We are sitting on a treasury of 5,500 crores. At the same time, online generates a lot of cash. So, and I already told you that Vidyapeeth, Pathshala put together will be EBITDA positive. The net offline learning segment of the company will become EBITDA positive by next year. For the ease of market, we will be reporting online revenues and offline revenues separately by next year. And Vidyapeeth versus Pathshala. Pathshala is a smaller business. Vidyapeeth is a larger business. So we will continue to focus on growing Vidyapeeth and making it more hybrid and more learner centric.
Okay, so that's with regards to where your platforms go, and 150 odd crores is what you're saying that you will need in terms of capex. But the margin impact is something that the street will be watching out for, because that has been a concern that the street has highlighted. So I think that's something which you should be ready with going ahead. But thank you so much, Pratik, for joining us on the show. Always a pleasure to speak to you in terms of what's in store for 2026, because here we're talking about a model which will be an offline plus online model, and the margin pressures that could be coming in when it comes to physical centers, whether your online model is able to really offset that impact from here on. A stellar listing, but whether that continues to see that up move is the key from here on.
I would say the big unknown for not just their business but for the entire edtech space is AI. Yeah, and very intelligent AI. I mean, we're all using it, right? Yeah. It's just natural. You have now a generation who first goes to AI rather than search.
Sorry, it's not just generation. Yeah. I do that the same. I'm the same boat.
Same, yeah.
Yeah.
All your generation.
No, but I think there's a generation that has not known the Google search. That their first sort of initiation into this whole space is, okay, you go and ask an intelligent computing technique on everything. And I think it's going to be used to help you with your schoolwork as well, or your education, or your classes, or your tests, or make this simple for me, or break it down and show it to me in a diagram. I'm not saying that, physics Wala is not going to be on top of it, but that's going to be one big challenge.
That's a mother of a kid who is doing all of this.
Yeah. Well spotted.
I wonder if Manish Sonthalia agrees with that. Let's start this conversation with him, not on the market wide, but just this thing. Manish, are a clutch of business models out there waiting to get disrupted because of AI, or will they adapt AI and still be on top of the game? Physics Wala was the reason why we were having this conversation, by the way.
So the whole idea is that traditional business models will have to adapt to AI over a period of time. And in that context, many of the revenue streams which currently are available for these companies are no longer going to be available in the AI adaptation mode. So yeah, I agree with you. The physics wala, edtech as a whole, will get disrupted, so to speak. Another thing out here is basically customer acquisition cost. We have seen in many new gen companies, Nykaa, etc., when they came out with an IPO, the operating leverage playing out due to diminishing marketing costs does not really come through. and the valuations, etc., get impacted because of that. So it all depends on execution on the top line, and which is a function of your scalability, ARPU, as well as your AI adoption. Correct.
Okay, so that's with regards to where the edtech space goes. Manish, good morning. Hiral on this side. Staying with the AI theme, what I want to ask you is the way your IT sector can be viewed as well, because we're breaking it up into various segments. You're talking about product-related companies. You're talking about service-related companies. H-1B visas could be concerns for your service-related companies as well. How would you look at all of these in 2026?
These services businesses don't fall off a cliff. And Indian IT is basically a service. So, the existing contracts or even the new contracts are going to get fructified, albeit at a lower pace. So yes, $1 lakh visa fee is a cost escalation, plus the number of visas that you're going to give. All of that will translate to, again, adapting of the business model more towards offshoring, more hiring on site for local presence. And GCC is obviously eating into the market share of the traditional IT vendors. Coupled with that is basically your AI adoption. And I think over a period of time, Indian IT guys actually, adapt to new technologies, applications will get molded around the AI theme. We have already started seeing companies like TCS, HCL Tech report AI revenue separately. Vendor new deals or new client deals would come through in terms of efficiency gains on account of AI. Only moot point out here is that if you are going to hire lesser number of people, where is it that the pricing power comes to? Because at the end of the day, time and material, if it gets disrupted, that business model gets disrupted. It's more on account of outcome-based pricing. Then for efficiency gains, the software companies need to get compensated. So over a period of time, pricing is going to be a good metrics to look at as to how the traction is getting built around AI. But given the current backdrop, reporting AI revenues separately is a good thing. And 6% sort of a growth in the Indian IT space looks doable. Valuations have corrected, so, and plus rupee depreciation. So all in all, good place to be in the current context, I would believe.
Manish, hi, very good morning, and great to speak with you. I think if you look at broad themes for 2026, definitely AI and what it does to Indian IT will be one of them. But the recurring point that we hear from everyone is that the best is yet to come for the BFSI space, for bankings and financials. Even though you saw some boost from the GST cuts, etc. Do you believe in that as well? Do you have a similar opinion?
So look, in the broader context, government is incentivizing to borrow and spend. Income tax cut, GST cut, and if you are not compensated, there's not a commensurate increase in income, you can always leverage and spend. And because interest rates are very low, it is expected that credit growth in the system is going to go up. And that is the delta in the BFSI space because of the very recent rate cut that you saw. NBFCs are going to have a front loading of the cut in their borrowing cost, leading to expansion in margins. Banks will do that over a period of time through lowering of your deposit cost. So valuations, etc., are very, very reasonable in the BFSI space. Both the NBFCs and the banks, even public sector banks, some of them are trading at very reasonable valuations. A case in point is that the volume of credit is going to go up, and margins over a period of time, we'll see the bottoming of margins for the entire BFI space, and valuations are very reasonable. Maybe the best is yet to come.
In calendar year 2026, the next 2 quarters, where and when in the cycle do you see that happening? And do you see then maybe your NBFCs kicking off more than perhaps the private banks, which have been the favorites?
So typically it takes around 6 to 9 months for the entire rate cut to get passed on, for the banks per se. For the NBFCs, the borrowing cost impact will be immediate. For the banks, the rate cuts linked to will be basically passed on in terms of lending cost where it is repo related or repo connected. But the deposit cost will get passed on over a period of time. 6 to 9 months is the time frame. I think in the next 2 quarters and beginning fiscal 2027, if you believe that there is not going to be any further rate cut in February, or maybe the rate cut is going to happen in June, then broadly you are likely to see the bottoming out of margins by the fourth quarter of fiscal 26.
Okay, Manish, the other thing is buckets where you are really reasonably confident. Now, you know, things are changing very fast, right? Just everybody was constructive autos and suddenly the raw material prices are playing havoc with what could happen in Q3 margins. And that may alter the price of the stocks in the short term, even if the long term may look good. So I'm just wondering if your list of favorites has changed through the course of the quarter. Where is it that you're most constructive on as things stand for 2026, whether the first half or whether the whole year?
So consumption and primarily focused towards the premium end is not going to see any dent in demand because of rise in raw material cost or anything else. So premium end of the consumption, and whether it be catering to automobiles, jewelry, you know, consumption goods, etc. Plus, where there is a brand salience which is still intact, and we through our research have really come to the conclusion that basically there are 4 categories or sectors where brand salience is very much intact. Maybe the other consumption categories, brand salience is getting diluted due to D2C. And which are these 4 categories? Consumption, basically automobiles, real estate, jewelry, and alcohol. You know, here people don't compromise on the brands per se, but consumer durables, you know, FMCG, because of D2C, Mamaearth of the world, etc. Brand salience is getting diluted. So from that point of view, premium end of the consumption looks very good. We believe that Indian markets are going to be much better placed in calendar 26 vis-a-vis calendar 25. And so capital market is a theme. You know, valuations also are very reasonable out here, given the growth. Everything related to capital market theme should do well. We are positive on rate sensitive, which is BFSI. You know, the banks, the insurance, the real estates, the automobiles, autocoms, and, you know, you have a budget coming through. Today, there were some media reports suggesting that PLI is going to get doubled in autocoms. All these spaces look very good. IT as a contra play, and pharma, if you were to see selective positive news flows come through on the CDMO front. Nice. I think these would be the favored sectors currently.
That's a large bucket. Manish, I'm wanting to ask you one question because I'm sounding like a broken record when I'm asking people about the capital markets theme. But to you in particular, you have not shied away from betting on the micro caps as well in this bucket. Seemingly, you are very constructive here.
Yeah. I mean, see, I think the foreigners, particularly so in the wealth management space, where even the smaller companies, if they start early, you know, because the foreigners have lost it in the wealth management space. You have all the wealth managers who are basically Indian guys, Indian companies, you know, the Morgan Stanleys of the world, etc. They have vacated this space long time back. So I think the pie is very big. Over a period of time, you will require intermediation for your wealth management. More people are going to get affluent, and UHNIs are going to be in very large numbers. So, and these are very high operating leverage business. There's not too much of capital intensity out here. Only cost is people cost, and bulk of the cash flows come down to your bottom line, and you can pay dividends out of that. So, you know, and these are very high entry barrier businesses because your captive clients, particularly so when you are talking to, let's say, 50 crore plus ticket size, they don't switch very easily. You know, the 5 crore to 25 crores, etc., is basically a fungible client base which move. But otherwise, this space, the wealth management space, even the smaller ones, have a right to win in the long run, provided they stay the course. Don't throw in the towel, ups and downs, because these are fantastic businesses. Other businesses are also small caps, and, you know, the RTAs, the depositories, again, you know, the 75 crore PAN accounts, only 21 crore demat accounts, long way to go. Profit pool getting shared between 2 players. You know, very little chance of a third player coming in now and making it big. So all in all, the economics of the game in the capital market space is defined in such a way that large pool is getting shared with a fewer number of players, and there's not too much of capital intensity, which makes it a perfect business model going into the long term.
Manish, come to the studios one of these days next year and let's do a show only on this theme because you seem to have great insights here. So it'll be lovely to do that. But on that note, from all of us out here in the NDTV Profit team, Manish Sonthalia, to you and everybody at Emkay Investment Managers, a very happy new year. And guys,